It is very difficult to predict when the next recession or stock market crash will come. So many of the best investors don't even try. Instead, look for good companies with the strength to make it through the occasional challenging economic environment, says Melody Hobson. Hello and welcome. In today's video, I am analyzing Cochin Shipyard. It is mainly engaged in the construction of vessels and repairs and refits of all types of vessels, including upgradation of ships, periodical layup repairs, and life extension of ships. Let's begin our analysis by looking at core ratios, beginning with the return on capital employed and return on equity. In the latest year, they have generated around 24.9% of ROCE and 18% of ROE. The ROE has been growing since last 5 years at 31.6%. So this is a very good compounded growth that we see in return on equity. It shows efficiency of the management. Next, let us look at the net block. 3 years back it was 371 crores and that has increased substantially to around 739 crores. As a percentage of the balance sheet, it is just 10%. So it's good. It's not too much of assets occupying the balance sheet. And there is also growth in the amount of assets that the company is employing into the business. Debt 3 years back was 123 and the preceding year it was 123 again. All of these years it has been very stable at around 123 crores. Also, as a percentage of total balance sheet size, a very small figure. So the company is almost debt free. In terms of interest, it paid around 45 crores in the latest 12 months compared to the debt of 123 crores. And this is a very small portion, and even if we see, the debt can be easily paid off using the profit of the current year. So that is just 0.19% of the total profits. Profit after tax of the last 5 years is 2,100 crores. Out of that, the cash received is just 689 crores, a very small portion over the last 5 years. I would generally want the cash to be coming in as high as the profits declared. The free cash flows is in negative, which I don't like. Not only is the cash not coming in, but the free cash flows are also negative, which means the company is deploying a lot of its capital into purchase of assets, and even when the cash is not coming in. Let's do a balance sheet analysis. Investments is 130 crores, a very small portion of the balance sheet size. Cash equivalent is huge at 3,441 crores, so almost as half of the balance sheet is in cash. Trade receivables is 320 crores, a small figure. Trade payables is 504 crores. So trade receivables, trade payables are very nearby to each other, as well as a very small portion of the balance sheet. The only issue here is that the company has a huge cash surplus which it needs to deploy into its business. The company was collecting its payment from the customers within 54 days, which has in fact reduced now to 30 days only. So this shows efficiency in the company, although cash is a very high value against the balance sheet total. Market cap currently stands at around 4,733 crores, and we don't have the data of the last 3 and 5 years. The current price earning is at 10.3 times, that is, for a profit of 35 rupees per share, we are paying 360 rupees. So that's a reasonable price to earning as per my benchmark. Valuation ratio wise, the price to earning was 10.3 times. Price to cash is little expensive at 18.7, although below my benchmark of 25. Although the cash inflows are less in this case, market cap is just 1.75 times its sales. So all of these valuation ratios are good. That is, we are able to buy into this company at a reasonable price or valuation. The book value around 3 years back was 240 rupees per share, which has increased to 280 rupees. So the book value hasn't gone up that substantially over the last 3 years, and the price is also not very far off from where the book value is. This is the value of the share as per the company's books, and price to book should be less than 2.5 times, which it is in this particular case. Return over 1 year and 3 years was both negative at 12% and 7.58%. So investors have lost money even if they had invested 3 years back or even 1 year back, although not that substantial, but a compounded degrowth of around 12.9%. Next, let us look at the pros and cons. The company is debt free, and pays a good dividend yield of around 4.64%. The profit growth rate is at the rate of 55.78% over the last 5 years. So whenever you get a very high growth rate in profits or sales, you should check out individual values. Dividend payout is also very high at 36.9%. This would be because the company has a huge cash and it doesn't need more and more cash. So out of the profit what it earns, it pays it back off to the shareholders. The company's collection days has also increased from 56 to 30 days. Contingent liability seems to be very high at 3,200 crores. So this will need to be checked against the net worth. Earnings also includes another income of 209 crores. Moving on, let's compare Cochin Shipyard with Mazagoan Dock and understand the peer group analysis. Cochin Shipyard's current price is 358 and Mazagoan Dock is available at 195 rupees. Many of the ratios of Mazagoan Dock won't be available as it is a recently listed company. Cochin Shipyard is down by around 27% from its 52-week highest price point, whereas Mazagoan Dock has fallen around 10%. In terms of growth in sales over its previous year September quarter, Cochin Shipyard has fallen around 32% in its revenue from 972 crores in September 2019 to 657 crores, whereas Mazagoan Dock has seen a growth in its sales from 951 to 1099 crores. Quarterly profit has fallen for Cochin Shipyard by 47% from 207 crores to 108, whereas Mazagoan Dock has seen a growth of around 11%. So both sales and profits have gone up for Mazagoan Dock. If we compare the March 2020's sales with the recent 12 months, Cochin Shipyard sales has fallen from 3,422 crores to 2,702. Since Mazagoan Dock has been recently listed, the values are almost the same. Profit after tax for March 2020 when compared to the recent 12 months has fallen for Cochin Shipyard from 636 crores to 460, whereas Mazagoan Dock has generated around 484 crores in the recent 12 months. In March 2020, the cash inflows for Cochin Shipyard is way low than the profit it has declared, 36 crores, and cash coming in is just 252 crores, whereas Mazagoan Dock's cash inflows were in negative at 95 crores compared to the profit shown of 484 crores. So I want both of these values in positive as well as nearby each other. That is, cash should be as good as the profits declared. Cochin Shipyard's last 5 and 3 years price earning was around 10.7 and currently also it is available very near to its average. Mazagoan Dock's current price earning is 8.15 times. So both of these scripts are available at a reasonable price earning. In terms of price earning and price cash, Cochin Shipyard is 10.23 and 18.65. So both are reasonable as far as my benchmark is concerned, whereas Mazagoan Dock's price to cash is negative 41 times because the cash had gone out of the business in the recent 12 months compared to the price earning of 8.15 times. If you don't understand any of these ratios, do let me know in the comment section and I'll try to elaborate about it in the next video. As also you can watch my other videos which are of 1.5 hour duration from the playlist section where I have explained each ratio in detail. Also, if you would like to learn from me, do contact me on my email address and I'll revert back to you. Market cap to net worth, that is price to book wise, Cochin Shipyard is trading at around 1.2 and Mazagoan Dock at around 1.26. So both are available at a good valuations as far as price to book is concerned. Profits for Cochin Shipyard is growing at 55%, which was one of the positive points for this company, whereas in the recent 3 years that growth has reduced to around 25%, whereas Mazagoan Dock's profits have fallen by 6% compounded over the last 3 years. So we want the 3 years profits to be growing at a faster rate than the 5 years, but whenever we see such high values, look at individual values in the P&L account. Cochin Shipyard's sales although have gone up by 16% in the last 5 years and in the last 3 years at 18.4%. So this is a good value. We want the company's sales to be growing, which will suggest to us that there is demand for what the company is offering the market or in the market. Even Mazagoan Dock's sales are growing at 12.4%. So at least sales wise there is no issue for both of these companies as of now. ROE of the last 5 years was 16.1 and in the recent 3 years the average ROE has fallen to 15.9%, and in the latest 12 months it has generated around 18% of ROE, whereas Mazagoan Dock's long-term 3 years average ROE was 16, and currently it is below its average, that is at 15.42%. So we want the ROEs at least to be above 15% or above its long-term average. In terms of return on capital employed, Cochin Shipyard is generating good returns of around 24% compared to its long-term averages. Even Mazagoan Dock is going at a good rate of around 24.98%. Return on assets for the last 5 years for Cochin was around 15%, and over the recent 12 months 16%. So this is the profit that the company has generated on its total balance sheet size. If you look at the asset turnover and inventory turnover, Cochin Shipyard's asset and inventory turnover are good at 15 and 16 times. That is, the sales is higher by around 15 times against the assets and 16 times against the inventory. Whereas Mazagoan Dock, because it may have less of assets against the revenue it is generating, the multiple is quite high. So this will need to be looked into as to why there is such a high asset turnover in this company, whereas inventory wise it's at a reasonable level of around 10.6. This we have already seen earlier. Cochin Shipyard's profits over the last 5 years was 2,100 crores, whereas cash coming in is almost 1/3 of the profits declared, and free cash flows are also in negative. So I don't like when free cash flows are in negative and cash flows are not coming over the long duration of 5 years against the profit declared. Same is the case for Mazagoan Dock at a negative free cash flow of 528, that is investing more than what they are earning in cash. Also the cash inflows are way too low, 1/10 of the profit declared over the last 5 years. So both of these companies are not doing good in terms of generating cash flows for the company. Contingent liability for Cochin Shipyards is as good as its net worth. This also I don't like. I don't want the contingent liability to exceed 20% of the net worth. Now if you have to understand what is the net contingent liability in this case, we'll have to look at the annual report and understand. Whereas for Mazagoan Dock, the contingent liability far exceeds the net worth of the company by a huge margin. Cochin Shipyard's debt is very nominal, almost negligible, and the coverage is also high at around 14 times. That is, its EBIT, earnings before interest and tax, is almost 14.7 times higher than the interest it is paying. Mazagoan Dock is a debt-free company and the coverage is 22 times, so much better than Cochin. Promoter holding for Mazagoan Dock is 84%. This will need to be reduced eventually. Even Cochin Shipyard's promoters are holding 72.8% and no pledge in both the companies. Debtors to sales ratio is 11% for Cochin, which is a good value because we don't want a very high debtors compared to the sale the company is doing, that is in the recent year, whereas it is also collecting its payment from the customers within 30 days. This shows management's efficiency basically. Whereas in the case of Mazagoan Dock, it's not a very good value. The debtors are almost 30%, which is my benchmark against the sales. So company still has to collect 30% of the sales of the recent 12 months, whereas it's taking 106 days to collect payment from its customers, which is absolutely not a good sign. My cutoff here is 90 days. Net profit margin for Cochin is around 18% and also gives a good dividend yield of 4.6%, whereas Mazagoan Dock's NPM margin is below my benchmark of 10 and no dividend yield as of now. Let us also look at the shareholding pattern of Cochin Shipyards. Currently promoters are holding around 72%, public is holding around 15%, DII is 9% and FII is 1%. So FIIs have exited, if you see, gradually over the years to just around 1.76%. Even DIIs have reduced their stake to around 9.4%. Only the public is going up to around 15.9%. I don't like when public is holding a very high percentage in a company. So let us look at the RSI indicator for Cochin Shipyards. Currently the price is at 359 rupees and the RSI levels are at 56 and 55. The right time to buy into this particular company was at 240 rupees and from there it has already given 50%. I had already made a video of Cochin Shipyards at this particular time period where I had indicated that it can be bought at these levels, because it had already dipped below RSI 35, both the lines, and can be bought in this, and I expect around 50% from here on. So it has already reached that, but I see a higher potential till minimum 411, where it will face some kind of resistance. There is a possibility of it going till 463, but there is no buying opportunity as of now, I feel, because the potential has already completed for me. This is the actual time to take an exit once you get whatever percentage you have predetermined that you want, and therefore the best thing is to wait patiently now for the prices to revert back to around 274, 246 and 217, and then decide if you want to buy into this company based on the price earning, price book, as well as technical chart both. So this concludes my detailed analysis of Cochin shipyards with Mazagoan Dock. If you enjoyed watching this video, consider subscribing if you haven't, and share it with your friends. Thank you very much for watching this video. Have a nice day.